76 3/4, I'd be tempted to go long, knowing there'd be an angle coming down here that might be breaking out, and using the low of the move here as my stop. Because if it turns up here, we could easily close the gap, and you could make at least a buck or two, and it could actually start an uptrend again after a 5-wave down. So this would be a potential buy based on the fact that our gaps are indicating this is some kind of powerful level. Now, of course, if it continues down, this might just be the midpoint of a much bigger drop for another 10 points or more lower. So I'd only be interested at this particular level and turning up to be a buyer of it. Now here's that past chart we saw that was going down, and we see why it may be making a stand here. It is at one of the areas of a pullback where it had a previous low, and I have an offset angle here of 45 degrees from the last run up down, so it's trying to escape from the resistance of that 45 degree, which is potentially bullish. And I've gone back to our lows here and showed you some circle techniques. From the first little top, there was a circle that went down and caused a little low over in here. And then from the first little top over here, note both the top of the circle was resistance right in here, and then the bottom of the circle gave us a little pivot. And then the next top over here gave us resistance, which turned out to be a gap. And then it came down here as a low. And then the third one up here was coinciding with not only this little top, but also this level, which is trying to make a stand on right now. And the bottom of this circular arc gave us basically a high here. So we know the circle top is an area where it could be resting on. Now, using this last top over here, we do have a potential low coming in, which still seems to be about a week away or so. So it may need more of a base, and it may even plunge a little bit lower. But if we can get into this area where this pivot is and get a turn and show some strength, then it might be a successful test, and this could yet be going up to substantially higher prices. But I would in no case want to be buying it $1 or more under 78. Otherwise, we would run the risk it would at least go down to 70, and maybe even have to go down into the gap area here at 63, and more of a giant 50% retracement of the entire move. No discussion of trading and strategies would be complete without some talk about moving averages. I usually don't use moving averages very often because I prefer to look at the individual bars, which really have the DNA information encoded in them. If you start looking at moving averages, your eye gets away from the bars, and you start to forget about the patterns that we're looking for, because the patterns is what determine the trend. And while a moving average for a while will work, once the market starts to change its characteristics, the moving averages will lag for quite a while, and you'll get whipped up. That's why most moving averages systems at best bet 50-50 and no higher percentage gains, because ultimately the market changes and the moving averages leads or lags. But there are three things you can do with the moving average that makes sense. One is approximate a trailing stop of so many bars back to stop you out on a trade once you've decided to get into trade by some other method. You can also, as a second criteria, you could use moving averages to determine the broad trend if you're going through a database of hundreds or thousands of stocks. So very quickly you can see a trend with a moving average rather than having to lay your angles on. And third, they are used often in my work to identify cycles. Since cycles cluster, you will get a certain time every so many weeks or years where the market will be greatly elongated above the moving average. And that will be the point where all the cycles cluster. So let's look at a couple of these methods, what we might want to use them for. On this first chart is a 60-minute chart of Goldman Sachs. And I have on here a simple three-day moving average of the low. And this could be used if you were going to use a trailing stop of 2 to 3 bars back. So let's say you have this little decline, and at some point you take the low of the high buy signal bar. Maybe you had an angle coming down to be extra safe, but somewhere in here you'd be going long. And at that point you would use your stop as the 3-day moving average. If you had a steep momentum advance, these works very well, and they'll keep you in the trade for quite some time. Over in here you actually got stopped out. Then they went down. Now you might have gotten back in here. Although this was the low of the decline, usually if you get a tiny little bar after it and they're slightly higher, slightly lower, that usually is a good buy signal to get back in as the high of a low bar. But by the 3rd day after that, you would consider a buy. And so if you did buy it again, you'd still be in, possibly get stopped out here, possibly here. It's a little close to call. But remember, these are moving averages. So let's say you did get in here and you're worried about getting stopped out here. But if you went back 1, 2, or 3 bars, you may really logistically have a stop at like the midpoint of the 3rd bar back. If you see it was a very big bar, you could still have a stop at the low, and then only after you get into this choppy range would you move your stops up. So I wouldn't necessarily have the stop right on the moving average, but it's something to look at to see where you could stop yourself out. And certainly if you get to the point where you're going through the moving average and it is turning down, you definitely at that point show that there's a downward bias and you would be stopped out. But we can see in here you can capture long runs at a time over several hours and quite a few points by just being objective and using some kind of a moving average on a short-term basis. Now I mentioned previously that the definition of a bull or a bear market often hinges on the fact that you've broken back below 90 days ago. So if you're trading at a price level not seen in 90 days, most of the time you're in a bear market. So if you are a very long swing trader or mutual fund investor or something like that, and you're using a weekly stop loss, at the worst case, you would want to be stopped out if you saw your price go back 90 days, which is about 3 months, which is about 12 weeks. But when you use a moving average, sometimes you want to lead and lag these things so the average will approximate what the prices actually were 90 days ago. You don't have to be a rocket scientist to figure these out. One simple way would be just draw a line like I have here on December and another one in September. So this is our 90-day period. And then we can take a bar that's in between here, and this would be a measuring bar of a 90-day distance. And we see here that the prices about 90 days ago are right at our moving average. So to that extent, the moving average is approximating prices 90 days ago. If we look a little closer at this, we can see that our bar won't always be 90 days ago. It approximates it. So as I move this across here, you'll see here's the 90-day prices 90 days ago, and here's our moving average. So today, we're still well above our moving average, and by the time we break it, we are getting below or pretty close to where they were 90 days ago. And we can see all along here the moving average is pretty close to it. But there again, you may want to verify it with a bar or something like this to actually see what's going on. If at a point like this, where you're going to be going up 90 days ago, you're clearly going to violate your moving average because these prices are not going to be turning up dramatically. But oftentimes you'll see a consolidation like this where it may hit the moving average and not really mean anything, and you can anticipate there may just be a consolidation. So we can take this moving average and go all the way back through time in a number of places and see how it works. Here's another event. Maybe we got in at the low of a high bar over here, and this would keep us in the trend until somewhere over in here. And when we're going over in here, we could check our averages to see, okay, at this point, are we really under prices? Yeah, it looks like we're probably getting under prices 90 days ago. And you get a little whipsaw here because they go up again. And we could continue on, and we see that, okay, the 90-day rule keeps us in the big trend. Now, there is a problem with this, of course. There's an obvious problem with using this as a stop loss. And the obvious problem is your money management. Although you don't get stopped out on this 90-day moving average, which is a 18-week moving average approximating like 90 days, look at the percentage loss you have to undertake in a position before you get stopped out. Over here, the stock is 163, and down here, if it plunged, it would go to 136. So you could be losing 20 or 30% of your money on some trades if you got in and it came all the way back down using this as your trailing stop. So you don't really want to use this as a trailing stop so much as you want to use it to identify the main trend. If we're going through a number of stocks and we're trying to find ones to buy and sell, we want to buy the dips in an uptrend. So when we have these moving averages put on anywhere in here, we can objectively say, yes, the stock is still in an uptrend, even though it's been down for 2 or 3 weeks. Maybe it's going to be a 6-week correction in the bull market. And anytime we have an ordinary dip on maybe a 1-week basis or a 3 or 4 trading day basis, as long as they're making higher bottoms, we can justify going long. And then maybe we can use our actual stop as the low of the prior week, or maybe a 3-day individual day stop, which might be the midpoint of the prior week. And at that point, we can fine-tune our money management so we're only going to lose 1 or 2% on our trades. And at the same time, when we do lose that 1% on our trade or with a trailing stop and we get stopped out, we can see what the big picture is after a correction and the moving averages turn up. We can see where we want to be certain that we think about getting back in again on a buy signal, that the long-term trend may be reasserting itself. So in this way, a moving average can be used to show the trend fairly clearly and very quickly on a scan of hundreds of different stocks. And once we find that the trend is up long-term, then we want to look for some kind of correction on a 60-minute chart or on a daily chart to look for the low of the high bar and get an entry point, and then fine-tune our stop with maybe the 60-minute chart trailing stop on a 3-bar average or something like that. I had mentioned that the third way we use a moving average is for cycles and identifying cycles. So if we have a moving average that seems to fit the data pretty well, what we want to do is we want to identify the biggest elongation or the amount that the price structure ever gets above the moving average. And once we find that, we check to see that here it's a little bit bigger, not quite as big. But there will be times when if you get this high and then you get that high again, you're going to be the maximum the market can go because all the cycles cluster. So what I mean by that is maybe there's a 15-week cycle and there's a 20-week cycle and there might be a 40-week cycle. But somewhere along there, they will all gang up and there'll be a common denominator at a point that will be the greatest it can be above the moving average. And in the future, you're going to have that same amount, the greatest amount it ever goes under the moving average. Now here we had a bigger one, so I know I don't have enough data. Preferably you go through about 10 years of data to find out where these great big moves are. But as you find yourself so much above a moving average, there is this regression to the mean, where they will try and get back to the moving average. And some people prefer to put envelopes on. And you can put this an envelope over your moving average at the extremes it ever goes to. And that's a good way of identifying where cycles are. And once you identify where the cycle is, you start to count how many weeks there are between these extremes. And that gives you a good idea of what long-term cycles are operating in the market. Now let's take the approach of how you would actually begin to trade from a very rudimentary perspective. And we'll start looking at the E-mini on an hourly chart because that's a good chart to show the waves and many fluctuations on the E-mini, but the approach would be the same whether you use a daily or a weekly chart or any other. And the